Good morning, everybody, or good afternoon, depending on where you are. I'm Jerry Marlatt. I'm a partner in the capital markets group of Mayer Brown in New York. First, we have Neil Hamilton, a partner in our London office. I've known Neil probably for, I don't know, a long time, Neil, maybe close to 20 years. Peter Pears, who's also a partner in our London office. Remmelt Reigersman, who's a tax partner at Mayer Brown and has been giving me tax advice for more than 15 years. And last but not least, because she does all the heavy lifting on these deals, is Chelsea Weiermiller. Chelsea probably knows as much about ABCP as any of us on the panel. So with that, we'll get started. Next slide, please. Very quickly on the agenda, we're going to do cover the state of the market for ABCP. We'll do just a brief introduction on CP and ABCP, and then I'll try to cover the U.S. law for ABCP conduits. Peter and Neil will cover the UK and EU law for ABCP conduits. Remmelt will cover the tax considerations. Chelsea will cover mechanics of ABCP, and then I think Peter and Neil will cover the various ABCP structures. With that, I will turn it over to Chelsea and to Peter to give us an overview of the ABCP for 2024.
Sure. So we're starting off by talking about market trends in ABCP in 2024. Issuance volumes are expected to increase in 2024 as new conduits are entering into the market and existing conduits are continuing to increase issuance. There is an expectation that investor demand will increase as interest rates stabilize or even decrease later this year. Specifically, we expect several new independent sponsor programs, CCP programs, and traditional bank-sponsored programs to launch later this year. Even as the markets and consumers face headwinds, the support that many of these programs receive from the globally systemically important banks reflects rating agency confidence and investor confidence in these programs. Rating agencies specifically take comfort in the fact that sponsors are generally sticking to their core investment strategies, and there is a continued focus on investor diversification. In terms of other new trends, blockchain and AI are emerging in ABCP as well. Some sponsors are testing blockchain for IPA settlement and CP, but challenges do remain here. AI is already being used as an important tool in due diligence, risk assessment, macroeconomic forecasting, and ESG analysis, but compliance and implementation challenges do remain here, particularly for large banks and other institutions. The portfolios for these ABCP programs have generally remained stable. Trade receivables, corporate and commercial loans, autos, those have all remained pretty stable over the last several years. However, we have seen an increase in capital commitments, real estate, and consumer loans as assets, particularly in the US CP market. Non-bank sponsors are expected to support additional derivative financing arrangements. Those have increased in volume over the last several years, particularly in the European market. Another recent market trend we're going to discuss is the issuance of green or ESG commercial paper. Several conduits have started to issue green CP, but it does remain a challenge to structure and create separate tranches for green CP. In addition, the critical mass of green assets is not yet sufficient for this market, and it is challenging to find common standards for green ABCP. There are currently upwards of 25 different standards out in the market, which can lead to market confusion. However, there are expected to be improvements in this area, which could help this sector expand. And now I'll turn it over to Peter for some additional information on green ABCP.
Yeah, just to mention that, reiterating what Chelsea said, the proportion of green ABCP compared to other markets is still quite small. We've seen a fair amount of green vanilla commercial paper now, but really only a couple of ABCP conduits that have issued in green or ESG format. And that's largely due to confusion about how to structure those deals. So do you follow a use of proceeds model? how concerned do you need to be in relation to the underlying assets? Hopefully with some of the clarity in and around ICMA structured green standards and the European green bond regulation, some of that will be allayed. And of course, we're likely to see in the next 5 to 10 years much more in the way of green and ESG related assets that people will be looking to fund via ABCP. So as Chelsea said, it's a relatively small, sort of slightly challenged market at the moment, but we certainly expect it to grow. Next slide, please.
Thank you, Peter. So just briefly on commercial paper, and I put into the appendix some more slides basically on the legal background for commercial paper, and those will be available when we send out the slide deck after the webinar. So commercial paper, obviously a term that refers to short-term corporate debt securities, typically with maturities of less than 12 months. Corporate commercial paper is used for working capital primarily, for inventory, for wages, for receivables, for other operating expenses, even for a nuclear power plant, for example, for nuclear fuel. Commercial paper has been around for a long time. It has pre-Civil War roots in the US, and it started with merchants selling their trade receivables into the money market. It transitioned to banks as primary investors, and then to corporates selling short-term securities to fund receivables and inventory rather than selling trade receivables. In 1933, commercial paper was kind of a problem for the drafters of the Securities Act, and the U.S. Treasury pushed very hard for an exemption for commercial paper because commercial paper, because it's issued so frequently, really was not amenable to the registration statement that was the primary focus of the 33 Act. As a result, we have Section 3A3 of the 33 Act that provides an exemption from registration for commercial paper. We had huge growth in CP volume in the 60s and 70s. And the market in commercial paper and asset-backed commercial paper peaked in 2008, probably at 2.2 trillion. It shrank very dramatically in the crisis. Asset-backed commercial paper shrank down to almost 200 billion outstanding. We're back probably to 400 billion outstanding today. But with the increase in interest rates, the interest in asset-backed commercial paper has grown pretty dramatically. Next slide, please. Next slide. There we go. Thanks. So the development of securitization in the 80s didn't bypass commercial paper. Merrill Lynch or Citibank, depending on who you talk to, developed the first receivables conduits that would buy trade receivables from corporates, funded by commercial paper issued by the conduit. This provided the corporates with capital markets access and cheaper funding that then was available through bank loans. And in a defensive response, other banks started their own competing CP conduits. And the success of the conduit structure expanded to funding many other asset types, including mortgages, portfolio securities, ABS, short-term loans, auto loans, credit cards. Next page, please. Next slide, please. The key feature of asset-backed commercial paper conduits are it's a revolving structure on both sides, both on the asset side and on the funding side. So as assets mature, the conduit buys more assets, and as funding rolls off, it issues more commercial paper. Conduits may be in the market issuing commercial paper as often as daily. Assets, if they're amenable, are match funded with commercial paper. But if they can't be match funded by commercial paper, they're usually supported by some kind of a liquidity facility or a guarantee. One of the key features for CP conduits, as for most securitization, is bankruptcy remoteness. The collateralized commercial paper structures, which are common, have become common for many banks, are used to finance their securities inventory positions or even loan inventory positions. CCP conduits, or excuse me, asset-backed commercial paper conduits can be used for warehousing. Receivables financing is still common, and we'll touch on it briefly, but some CP conduits issue series commercial paper. Next slide, please. Next slide, please. So asset-backed commercial paper conduits are a little bit intricate in the US because of the various legal regimes we need to deal with. First, the conduit needs an exemption from the Investment Company Act. Secondly, it needs an exemption from the US securities law on the issuance side. It needs to be concerned with the Volcker rule and the covered fund analysis. It needs to comply with US risk retention. It needs to establish a 17G5 website under the rating agency rules. There are various tax issues to be concerned about. There are issues related under Rule 2A7 for eligibility of the commercial paper for purchase by money market funds who have traditionally been big investors. The conduits may be affiliates for the intermediate holding company considerations in the US for banks. There are various accounting considerations and regulatory capital considerations. And as you can see, there's a lot to go through, and I'm going to do this pretty quickly. So really, I'll repeat, I encourage you to send us an email or give us a call if you have questions that require a more detailed response. Next slide, please. So CP is issued, asset-backed commercial paper is issued either under Section 3A3 of the 33 Act or Section 4A2. The privately placed commercial paper is more common today for conduits. But some of this CCP or repo program structures will want to comply both with 4A2 and 3A3 in order to manage considerations under the margin regulations. CP condos need an exemption, as I said, from registration as an investment company under the Investment Company Act. There are at least 4 different ways to achieve an exemption, but they all have their own peculiar limitations. Section 3C1 for commercial paper that doesn't exceed 270 days in maturity, but it raises issues under the Volcker rule. Section 3C5 for some special assets, mortgage loans, merchandise receivables, or loans to certain manufacturers and wholesalers. 3C7, which gives us the most flexibility, but again raises considerations under the Volcker rule. And Rule 3A7 for any financial asset, but with restrictions on the classes of investors and restrictions on trading in the assets. Next slide, please. So prior to Volcker, it was common for conduits to rely on Section 3C1 or maybe more rarely Section 3C7. Now bank programs, because often the bank programs are consolidated with the bank and banks cannot own a covered fund. Banks are relying more commonly on Rule 3A7, sometimes Section 3C5. Or if there's an ABCP safe harbor under the Volcker rule under 3C1. Aggregated programs run by non-banks may still rely on 3C1 or 3C7 because the Volcker rule is not as much an issue for them. Next slide, please. So the Volcker rule was adopted in 2013 pursuant to Section 619 of the Dodd-Frank Act. And basically, it's a limitation on banks' proprietary trading or their involvement with or ownership of a covered fund. This was directed primarily at bank ownership of hedge funds, for example, or private equity funds. But the way that the covered fund is defined, it's an entity that would be an investment company except for reliance on Section 3C1 or 3C7. Now, these had been very common exemptions used by CP conduits, as I said. So this now created issues for CP conduits. Many CP conduits were restructured to rely on Rule 3A7 instead of the two sections, or to rely on some of the exemptions that are available under the Volcker rule. There's an exemption for loan securitizations, for example, where the assets of the vehicle consist only of loans. And there's an exemption for qualifying asset-backed commercial paper conduits. Often, however, for investors purchasing commercial paper from a CP conduit, we can conclude that the commercial paper is not an ownership interest, because an ownership interest is defined as an equity, a partnership, or a similar interest. And senior debt is expressly excluded from the definition of ownership interest. Next slide, please. For bank programs, however, the bank must meet an exemption from the Volcker rule at both at the conduit level and at the transaction level. So if the conduit is consolidated with the bank, the conduit does not want to be holding an ownership interest in another covered fund. So at both levels, we will look for exemptions from the Volcker rule. As we said earlier, aggregator programs may use covered funds and rely on commercial paper not being an ownership interest. Next slide, please. Risk retention. So with the adoption of Reg AB2 in 2014, at the same time, the 5 agencies, the 4 banking agencies and the SEC adopted a risk retention rule. Risk retention requires the sponsor of an asset-backed security to hold 5% of the credit risk of the assets being securitized. And the sponsor is defined as a person who organizes and initiates a securitization transaction through transferring assets, either directly or indirectly through affiliates, to the issuing entity. Some sponsors of CP conduits will hold 5% of the commercial paper issued by the CP conduit in order to satisfy the risk retention requirement. Others may hold a 5% first loss piece in the conduit. Other sponsors may provide a full wrap security or a guarantee or a liquidity asset purchase agreement, particularly on CCP conduits where the bank is providing financing for its own portfolio or portfolios held by its affiliates. And finally, in some other cases, the sponsor can rely on the LSTA decision, which held that the sponsor in that case was not a sponsor under the risk retention rule because it did not transfer assets directly or indirectly to the issuer. Next slide, please. Also helpful is an interpretation from the SEC staff. The C&DI for section 301.03. This was an interpretation of a response to an insurance company that was depositing funding agreements into an SPV and selling interest in the SPV to investors. And the staff responded that in that structure, the commercial paper issued by the SPV or the notes issued by the SPV would not be asset-backed securities either under Reg AB or under Section 3A79 of the Exchange Act. But that's sometimes a useful exemption. Next slide, please. So just to summarize here, the standard risk retention options are a vertical interest, that is 5% of the commercial paper issued, a horizontal interest, so the residual interest, 5% of the fair value of the commercial paper issued. A horizontal reserve account, which has to be funded, or any combination of the above. And finally, there is a special provision for an eligible asset-backed commercial paper conduit under the rule. I won't go into the details, but it is available. Next slide, please. There's also a safe harbor under the risk retention rule for certain foreign transactions. One of the requirements for reliance on that exemption is that not more than 10% of all of the ABS interests are sold to U.S. persons. And that's a special definition, broader than Regulation S. And neither the sponsor nor the issuer is a U.S. entity or a branch in the U.S. And no more than 25% of the assets can be originated in the U.S. Next slide, please. We also, with CP conduits, need to be concerned about whether the conduit or the administrator needs to register as a swap dealer if the conduit is writing swaps, and in particular security-based swaps. We also need to consider whether the administrator of the conduit should register as an investment advisor under the Investment Advisors Act of 1940. Next slide, please. As I said at the beginning, money market fund investors have long been very important investors in the CP market and in the asset-backed commercial paper market in particular. Money market funds are subject to a diversification requirement for their investments, and they cannot invest more than 5% of their assets in the securities of a single issuer. And Rule 2A7 provides that with respect to ABS investments, if there any obligor in the conduit that constitutes 10% or more of the assets of the conduit, then the ABS that portion of the ABS will be deemed to be issued by that obligor. So the disclosure issues for CP conduits, in order for money market funds to comply with the diversification requirement, the disclosure requirements are just not feasible. So those conduits that will sell to money market funds will covenant that they will not have a 10% obligor in their in the conduit. The solution for is sometimes to split the assets among multiple conduits or move the assets into a non-2A7 conduit. Occasionally, you can substitute the bank as the primary obligor on the asset rather than the underlying obligor. And obviously, there are particular issues during the ramp up of a conduit where one big asset comes into the conduit that can be, during the ramp up period, more than 10%. Next slide, please. Bankruptcy remoteness, as I said, is a requirement, as it is for all securitizations. So that means that every agreement that the issuer enters into will have provisions in it providing for limited recourse and non-petition. But I want to just bring to your attention, we're going to talk in a couple of minutes about the National Collegiate Student Loan Trust case that was decided last week, that will raise some bankruptcy remote issues. Next slide, please. We also have accounting consolidation considerations, particularly for CCP conduits where the bank, as the sponsor, provides credit support for the conduit. The conduit may be consolidated onto the bank's financial statements. And if they're consolidated, the bank may be required to maintain capital against the assets held by the conduit. And also, in that case, the LCR requirements under the bank capital regs would apply to the commercial paper with a maturity of 30 days or less. And also that we should just raise here the capital cost of liquidity for conduits. Under the proposed rules in the Basel III Endgame, the capital requirements for undrawn liquidity lines are going to increase from 0% to 10% if the proposed rules are adopted. Next slide, please. Asset-backed commercial paper conduits, even if they're not owned by the bank, but they are administered by a bank, they may be affiliates of the bank for purposes of the Intermediate Holding Company Act in the U.S. when the bank is a foreign bank. And there is, however, although they're affiliates of the bank, no need to move the conduit under the Intermediate Holding Company. Next slide, please. So last Tuesday, I think it was, the Third Circuit issued its decision in the National Collegiate Student Loan Trust case. This is a very convoluted litigation that's been going on, I think, since 2014, actually. The court held in this case that the various trusts, National Collegiate Student Loan Trusts, and they were, I think, like 8 or 10 of them, were covered persons for purposes of the Consumer Financial Protection Act, and therefore subject to the enforcement powers of the CFPB. And the court held that when the trust hired third-party servicers to service the loans and to collect on delinquent loans, that the trusts were responsible for the violations by the servicers of the rules related to collection. This is going to have a fairly dramatic effect, and the analysis of the court doesn't restrict this conclusion to CFPB actions. I think the analysis of the court would apply as well to third-party actions brought against a conduit, so it's going to raise some real considerations. Next slide, please. It's typical in today's market for asset-backed commercial paper to be secured, to have a perfected security interest in the assets of the issuer. So this will raise a perfection analysis question under the Uniform Commercial Code of the jurisdiction in which the issuer is located. And if the issuer is located in a foreign jurisdiction, an analysis of the laws of that jurisdiction. For example, bank accounts in France, for example, will require a pledge under French law. And also the type of assets in which the conduit grants a security interest may involve laws may involve laws of the jurisdictions where the asset is located. Next slide, please. And finally, as with all securitizations that are rated, the rating agency regulations require that a sponsor maintain a protected, password protected website. And the sponsor is required to post onto the website all communications and information provided to the rating agency for the purpose of assigning a rating on a commercial paper. And additionally, all the information that's provided to the rating agency for purposes of maintaining credit rating surveillance. With that, I will turn it over to Peter and to Neil for the UK and EU law considerations.
Great, thanks, Jerry. Thanks, Caitlin. I think from a EU and UK perspective, you might be pleased to hear that actually the regulatory considerations are somewhat lower. So Neil will talk primarily about the securitization regulation and money market funds rules. When it comes to the securities themselves, the actual commercial paper, much of many of the notes issued are actually exempt from the main rules. So for the EU and UK prospectus regulation, on account of the short-term maturity of the notes, if they're less than 12 months, on the fact that denomination of ABCP is always higher than, or typically higher than 100,000 euros or equivalent, and the fact that it's not sold to retail investors means that the prospectus regulation is not something we need to take into account, and so you have a relatively free rein when it comes to drafting the offering memorandum in the UK and Europe. And PRIPS, that's the Package Retail Investment and Insurance product regulation, that will not apply again because we're not selling to retail investors. Similarly, in other areas, we wrestle with MiFID II product governance and the design of a target market for investors. We don't need to take much notice of that because we're not selling to retail, and therefore we just design the target market as professional investors and ECP investors only. And then when it comes in the UK to FSMA deposit taking, again, on account of the denomination of the notes and the fact that it's only sold to professional investors, if the issuer is not an authorised person for the purposes of UK deposit taking, ABCP, as with other CP, falls outside the scope of the rules. So fortunately, from a securities law perspective in Europe and the UK, it's relatively simple. On to Neil and the next slide, please.
Thank you, Peter. Peter's spoken about the pieces of legislation that don't apply. I'm going to speak about a couple that do. The main one in Europe and the UK is the securitization regulation, the EU securitization regulation, and the UK equivalent, which currently is pretty similar, although that's changing. But the main point to note is that the regulators in the EU and the UK treat ABC programs as securitizations, I think largely on the basis that typically an ABCP issuer will invest in transactions which are tranched and fall within the definition of securitizations from a regulatory point of view. So generally speaking, from a regulatory perspective, a regulated investor who's got an exposure to an ABCP program, that could be by holding a CP or providing a liquidity facility or a swap, will be looking at a securitization position. That has a couple of consequences. The main one is that there's mandatory due diligence that an EU or UK regulated investor has to carry out, and they have to verify principally the existence of risk retention and of reporting on the transaction. Risk retention, there are a number of ways of fulfilling that, which is broadly similar, but with a lot of differences to the US rules. But typically, the risk retention will be provided by the bank sponsor provided 100% liquidity. So for a fully supported ABCP program, the risk retention is in the form of the liquidity or asset purchase facility provided by the sponsor. That doesn't have to be risk retention at the underlying transaction level if you have a fully supported program, which is good news. In terms of reporting, there has to be reporting on specified templates by ESMA or the UK equivalent. The crucial difference from term securitization transactions is that there doesn't have to be reporting at the loan level. There is provision for aggregated information, so it's in some ways a lot easier to comply with than on a securitization. There are also various other rules that have to be complied with, such as disclosure of significant events and a transaction summary. Next slide, please. The other important aspect of the securitization regulation is something called STS, Simple, Transparent and Standardized Securitizations, which, if you obtain that label, means that a bank investor can obtain preferential regulatory capital treatment. So it's often bank sponsors that are looking at investing in an underlying transaction through the conduit will look to obtain STS treatment for a particular transaction. There are a lot of criteria that needs to be satisfied, so it's quite difficult for an individual transaction. It's almost impossible to have a program as a whole made STS compliant, just because it requires all of the underlying transactions to be STS compliant, with a small exception of 5% on a temporary basis. Next slide, please. Another advantage of STS and the money markets regulation is that money market funds can invest up to 20% of their assets in ABCP, which is STS, as opposed to 15% for non-STS ABCP. Next slide, please. So on to you, Peter.
Peter, I think you're on mute.
Is this me, Neil, or am I on the next slide?
Okay, happy to do it.
Sure.
So have a quick look at eligible ABCP for the money markets regulation, and as we put on the slide, the number of conditions for eligibility. Program has to be fully supported, not a re-securitization, i.e. none of the underlying exposures are themselves securitizations, and it doesn't include synthetic securitizations. The various maturity limits for eligible ABCP is set out on the slide. There's also likely future change in regulation. There's a consultation which is opened, so we're not sure when the changes will come into effect, but certainly change is likely in the medium term. Next slide, please.
I'll take this. So, Neil mentioned that money markets regulation in the EU is subject to future change. That's the same in the UK. So, at the end of last year, the Treasury published a policy note on the reform of the UK money market framework, together with a draft version of the regulations. And that's essentially the post-Brexit framework, part of the UK's smarter regulatory framework. And we're awaiting the final policy statement and the final rules later this year. There isn't a proposal to amend the limits that Neil mentioned before, the 20% and 15% investment limits, but the FCA is proposing an increase in the minimum proportion of highly liquid assets that UK money market funds need to hold. As Jerry mentioned, they're important to investors in asset-backed commercial papers, so we're waiting to see exactly what those rules will say and how they will affect UK money market fund investors. Next slide, please. Over to you, Remmelt.
Thank you. Yes, I'll be sharing a few thoughts from a U.S. tax perspective on ABCP. Generally, ABCP is treated as debt for U.S. tax purposes, and this is the case even though there's often no meaningful equity at the SPV level. From a tax perspective, we typically look to some amount of equity support to conclude that issuance as an instrument is debt for tax. But in this case, the market typically is comfortable that the assets that are supporting the commercial paper are viewed as sufficient to support that debt treatment for tax purposes. Now, one question then becomes, whether interest on that debt is U.S. source or foreign source. I guess with foreign source I mean is non-U.S. source, and that determination is important for tax compliance purposes. So whether that's forms collecting like W8, W9, or tax reporting. A wrinkle in the sourcing question is when there is a sponsor that is providing credit support or liquidity support, because that then leads to the question whether the commercial paper could be recharacterized as debt of the sponsor. And then the further question would be, does that have an impact on the source of payments? Even though it might impact source of payments, I mean, generally the recharacterization question doesn't impact the holders as much. In a traditional ABCP structure, it becomes more of an issue for the sponsor, and in particular, in the case of a cross-border situation, what the potential tax consequences are there. For example, if the SPV and the sponsor are in different jurisdictions, then you're going to need a pretty careful review of the type of fees that are being paid. So there could be credit support payments, there could be a liquidity fee, There could be other admin fees being paid. And the question becomes, as soon as those are cross-border, what impact does that have from a withholding tax perspective? Is there a treaty available that might avoid any type of withholding taxes? And so basically, on the tax side, the conclusion is that most of the tax issues that exist in structures like this are, what I would call internal structural issues that the sponsor deals with, and less so issues that impact the holder, since the holder's mainly looking to debt treatment of the commercial paper and payments thereon as interest. So that's kind of a high-level U.S. tax a review of ABCP structures, and I'll turn it over on the next slide, I think, to Chelsea.
So we're talking about mechanics of ABCP. ABCP conduits are similar to asset-backed securitizations, but they do have certain very important differences. The differences include investing in revolving assets. These often fluctuate in size, investing in various different types of assets, which creates a more diversified collateral pool, and also funding longer-term assets with short-term liabilities, which can create a cash flow mismatch. Because the CP matures relatively quickly, the repayment source often comes from rollover or reissuance of existing CP. As noted, many conduits have been in existence since, the early 90s and have been amended and restructured over time. We see conduits get amended for a variety of reasons. An example would include a desire to change the Investment Company Act exemption, for example, or a desire to issue CP in a new market, amendments to program limits, that kind of thing. Because ABCP conduit programs exist for so long, as a practical matter, it is important to review the various amendment provisions in the program documents for any desired changes to understand who the various stakeholders are and the process points that are involved. I would always recommend that whenever you are doing an amendment to an existing program, especially to a program that has existed for quite some time, to always ask for a conformed copy of the relevant program document that's being amended after the amendment is signed up, so that you can keep good records, because after you've had a program exist for 30 years or more, it can be challenging to keep up with those types of things. Next slide, please. So now we're going to talk about the primacy of liquidity in ABCP structures. So many of the conduits in the US, and I think almost all of them in Europe, are fully supported. So what does fully supported mean? A fully supported commercial paper conduit program ensures that the investors will receive full and timely payment on their CP at maturity without regards to the cash flows of the assets. In a fully supported program, the liquidity support provider would bear all of the credit and liquidity risk. A fully supported program may be directly or indirectly supported, but both would ensure that there is timely and full payment on the CP issuance. Investors seek payment directly from the support provider in the event that the issue cannot be retired at maturity, while under indirectly supported program, the support provider would either purchase the relevant assets in the program at a price to pay the maturing CP, or would make loans to the conduit secured by the assets in an amount to pay the CP. For an ABCP program that is partially supported, investors have a portion of the principal guaranteed by the sponsor, but generally speaking, it will be assigned collateral that is in excess of the principal amount in a form of credit enhancement known as over-collateralization. In a case of default, ABCP investors will have a pool of assets to claim for recovery, in addition to an unsecured claim from the guarantee provided by the sponsor. This offers ABCP a distinct advantage over unsecured commercial paper investors who will not have specific claims to such assets in the event of a default. So for credit support, program level credit enhancement can be provided by almost any type of arrangement where the amount available is not dependent on the credit status of the assets funded by the conduit. In addition to using letters of credit from highly rated banks, program level credit enhancement has also been provided in the form of a cash collateral account, a surety bond from a monoline insurance company, and everything else you see on this list on the slide. And over-collateralization represents the excess amount of assets held or transferred to the conduit with the base amount of the outstanding CP. The amount of over-collateralization required will vary depending on the asset quality of the underlying assets and is often specified as a multiple of historical losses adjusted for current market conditions. Next slide, please. Another structural component we are seeing particularly lately is a co-issuer structure. Co-issuer structures are relatively simple to amend existing program documents in order to add a co-issuer. Normally, we see co-issuers being added in the United States to an existing European program. Typically, we would see a co-issuer being set up in the United States in Delaware. But it is important to keep in mind certain regulatory requirements, like the Investment Company Act exemption and whether to register as an investment advisor in the US. And there are also important tax considerations to keep in mind. Next slide, please. So next we're talking about puttable callable CP considerations. So puttable callable CP offers both the holder with the put option and the conduit with the call option. The put option would allow investors to short the maturity of their notes when they deem it necessary. This may enable conduits to place notes with a longer stated term to maturity than would otherwise be possible. The put option may be of particular use in shortening the deemed maturity of the notes. If the put option is exercised, the sponsor would recognize the early redemption date designated by the holder as the relevant ABCP note's maturity date. Puttable callable notes typically require the holder to provide more than 30 days advance notice of any put exercise and entitle the conduit immediately to call the note, subject to a 1 business day notice required by DTC if the holder exercises its put option. Prompt exercise of the contingent call option by the conduit following an exercise of the put option will enable the sponsor to recognize an expected cash outflow in respect of the applicable puttable callable note for only 1 day rather than 30 days that would otherwise be required. A puttable callable note may also include a non-contingent call option that is exercisable by the conduit, whether or not the holder exercises its put. And with that, I think we're turning it over to our colleagues.
Neil and Peter.
Neil and Peter.
It's a good intro. I'll mute that. We'll spend the next few minutes talking about some of the various structures for ABCP programs and also some of the general considerations. So, I think on this slide that the main point that I would stress is obviously that there are certain differences between US commercial paper and European commercial paper. So, whilst when setting up any conduit, we'd be thinking about the range of regulatory restrictions and considerations in both worlds. They're obviously much more relevant for USCP in certain circumstances and ECP in others. Similarly, Chelsea talked about clearing and other matters and the location of conduit issuers. They will be different depending on whether you're targeting a US investor base or a European investor base. Next slide, please. Other things that we'll need to consider when we're setting up a new program is whether the program has full support or partial support from the sponsor. We'll see in a later slide that full support has become increasingly common. The tenor of the notes, whether it will all be short term, whether longer term will be possible, whether extendable or puttable or callable notes are required, whether it's an on-balance sheet and off-balance sheet exercise. And then, of course, all the sort of normal plumbing that you need to consider when you're setting up any kind of securities issuance program. So the identity of the dealers that will be selling the paper, the identities of the depository and issuing and paying agent, trustee, liaison with the rating agencies who will take a keen interest in the structure of the program. And as I mentioned, the location of the conduit issuer, which jurisdiction do you want them in from a sort of operational time zone and tax perspective, and questions around whether you want a single issuer or a co-issuer structure if you're accessing both the US and Europe. Next slide, please. So I think the most interesting piece of information on this slide is the graph on the right, which shows the sort of current distribution of the the range of assets that we see in US multi-seller programs. So it's still dominated by corporate and commercial loans, about just over a third. Auto loans, very common, and then other at 20%, but also trade receivables is a common feature of ABCP programs. Next slide, please. And just as it's not a homogeneous product, it's a product that's developed over time. So this slide is provided to us by one of our underwriter clients, and shows the differences in the ABCP market in the US, and both pre and post financial crisis. So pre-financial crisis, there was a range of different ABCP structures that were used. From, you can see that 47% were multi-seller structures, fewer single seller structures, but then also some structures that are much less commonly seen, like structured investment vehicles, etc., etc. Similarly, support tended to be partial rather than full. If you fast forward to 2023, it's got a different picture that we're seeing. So multi-seller programs are now the norm. Almost 80% of programs in the US are multi-seller programs, and the majority now have full support rather than partial support. So there's been quite an evolution post-financial crisis in the types of structures that we're seeing. And as Jerry mentioned at the top of the call, we've seen a lot of interest recently in establishing new conduits and expecting quite a number of new conduits over the next year. Next slide, please. Neil and I'll go through some of the different types of ABCP programs. I think we'll concentrate on the first four. So those structures that we see today are bank-sponsored multi-seller programs. Similarly, aggregator-sponsored multi-seller programs, bank-sponsored CCP or repo programs, and aggregator-sponsored CCP or repo programs. And to give you a bit more detail on what that actually means, let's move over to the next slide, please, Caitlin. So for a bank-sponsored multi-seller program, which I think represents the majority, it has all the features that we mentioned earlier in the call. So limited purpose, bankruptcy remote SPV, providing financing for receivable pools generated by multiple unaffiliated originators and sellers. These programs are most commonly established and sponsored by large commercial banks, and they're sort of an extension of the financing that they provide to their corporate clients via the CP market. The banks will, as well as providing the conduit itself, and as we showed, support in relation to the conduit typically, they also serve as program administrator and administrative agent for the conduit. The conduits are typically structured to make loans against or purchase interests in receivable pools, warehouse assets, and or purchase securities. And ABC, and this is an important point to stress, I think, is typically perceived as low risk for investors. One, due to the originator diversification, two, due to the asset diversification and deal specific credit enhancement that Chelsea's discussed. And of course, the bank sponsorship and other liquidity support as well. So generally a low risk investment. Next slide, please, Caitlin. And there on screen, I think given the time, we won't go through it, but for your future reference is a useful schematic of a typical multi-seller program. Over to you, Neil.
Thanks, Peter. Next slide, please. So looking as we wrap up some of the more specialized types of ABC programs, first the aggregator-sponsored multi-seller program. So it's very similar to a bank-sponsored program, except that you have an aggregator entity that will essentially rent its conduit on a transaction by transaction basis and receive fees for doing that. So that can have some off-balance sheet benefits for banks putting transactions through that, although it means that liquidity is very much a function of the particular transaction and aggregator. Next slide, please. Another variation in terms of types of programs is a bank-sponsored collateralized CP or repo program, where the underlying investment is a repo transaction or similar. So the idea being is that recourse security-wise, lending as against title to an underlying asset. So it's really designed as an alternative funding source for bank securities or loans. Next slide, please. There's also aggregator-sponsored CCP or repo program, which is the variation I've described as for bank-sponsored multi-seller. Next slide, please, Caitlin. You also have total return swap vehicles where the underlying exposure is to equity securities, passing on the total return of that, and conduit hedging its exposure by using CP proceeds to purchase the equity securities. And next slide, please. Final one is various forms of credit risk transfer vehicles. As you know, credit risk transfer and that sort of transaction is having increased popularity at the moment for regulatory capital purposes. There's various forms of structures under which banks can obtain regulatory capital relief through credit risk transfers, and in a number of different structures as outlined on this slide. So conscious of the timing, thank you. I'll pass you back to Jerry.
Thank you, Neil. If you have any questions, please feel free to email any of us or give us a call. We're delighted to respond to questions. And thank you very much for attending. With that, we will conclude the program. Thank you very much.